Welcome everybody to the special weekend edition of the show. Today, we talk about the week ahead. We discuss important earnings news and economic data that's going to move the market. We're also going to take a deep dive into the biggest stock in the world, Apple, as well as investing psychology for the long term. And finally, we're going to be analyzing a clip from CNBC where Scott Wapner talks about Tom Lee and the brutal sell-off the market has just seen in the past week. This is the S&P 500 weekly heat map. If you're a bear, congratulations. You probably made money. Google down 9%, one of the worst performers in the big tech names this week. We saw Amazon and Microsoft the best performers, and Microsoft and Amazon continue to hold up the Mag 7, the tech names, but we'll see what Apple and Nvidia reports in the coming weeks. Healthcare couldn't catch a bid. Same with financials, they couldn't catch a bid. But we did see some pockets of green. Consumer defensives did pretty well. Same with utilities and basic materials. It was a negative week, and the bears are licking their fingers. This week, we have some pretty big earnings, not as big as last week, but still very, very big. We have huge companies, Apple, the biggest stock in the world, reporting, as well as a lot of healthcare companies. We've got CVS Health, Pfizer, Eli Lilly, Novo Nordisk, Moderna. All of these companies are reporting. And then we do have AMD. It's going to be a huge proxy for what Nvidia is going to do, as well as PayPal. These are the implied moves for earnings. Apple right here, because it's really going to cause a lot of volatility if it misses on its earnings. So looking at 5% implied volatility up or down. But some of the hypergrowth names, Palanta, Shopify, Team, Moderna, their implied moves are looking at the double digits. We also have some major economic data coming this week, which is going to add to the volatility, particularly with the Fed on Wednesday, the 1st of November. We have the Federal Reserve decision on interest rates, the refunding announcement, as well as Jerome Powell's press conference. Particularly the refunding announcement, I believe, we're looking at about $1.4 to $1.6 trillion worth of T-bill issuance over the next 6 months, which is going to really weigh down the market, and we're going to have to see what happens to yields, because that's a lot of bond issuance that's occurring in the market, and it's really going to weigh on equities. And then on Thursday, 2nd November, we have initial jobless claims. That's pretty much the only significant one. I believe we're looking at a figure of 215,000. And then on Friday, we have some pretty big stuff. We have non-farm payrolls right here, US unemployment rate, US hourly wages, and ISM services. So some very, very big data points coming out this week, along with earnings. So there's going to be a lot of volatility in the market. We're going to be especially in individual names in stocks. But let's have a look at one of those individual names, Apple. Apple has generated its shareholders so much alpha. Both Steve Jobs and Tim Cook have done a fantastic job in running this company and taking it to where it is today. And so they do have earnings after the bell on Thursday. They're expected to produce an earnings per share of 1.39%, 8% year-on-year growth on revenues of $89.3 billion, which is a decrease of 1% year-on-year. But the reason why the earnings per share is increasing is because Apple buy back so much of their stock. A key driver is iPhone sales of 43.6 billion, which is hopefully an increase of 2% year-on-year. And particularly the one you want to look at is service revenue. This is still the biggest growth driver for Apple right now, as they monetize their 2 billion installed user base and a growth of 11% year-on-year. And I think if this number misses, there's going to be a lot of selling in Apple. I think this is the major number you want to look at. If this misses by a large margin, it really does say something about the consumer. Let's further dig into Apple's financials. This is alpha spread, and this is what I use to fundamentally analyze my long-term investments. I really like this platform. It's really, really great. It's really, really intuitive as well. And we can see here that alpha spread on the base case has Apple overvalued by 25% and their fair value at $128. Let's have a look at the fundamentals. So $384 billion in revenue, $112 billion in operating income, $94 billion in net income, $101 billion in free cash flow. You can see a very, very profitable company, which just has huge amounts of free cash flow every single year. When we go to their balance sheet, now let's actually have a look at their growth. Now we can see that in June 2013, they produced $169 billion in revenue. Today, it's $384 billion. And September 2026, they're looking at $485 billion in revenue. Still seeing quite a bit of growth in Apple's revenue. And then we look at their net income, $94.8 billion currently. June 2013, it was $37 billion. And we're looking at $130 billion in September 2026. So even though Apple is a mature company, they are still growing, although slowly, but it's really hard to grow a company that has $101 billion in free cash flow. It really is hard to grow a company of that size, even with the amount of free cash flow you have. Let's have a look at their balance sheet. Great balance sheet from Apple here. Have a look at this. So they have $123 billion in current assets, $62 billion in cash and short-term investments, and then $21 billion in other current assets, which is probably their Treasury securities. So realistically, they have this amount and this amount in cash. So I would say about $83 billion in cash, which is a very, very good cash pile in comparison to their long-term and short-term debt. So they have $98 billion in long-term debt, $4 billion in short-term debt, which is $102 billion in total debt. Their free cash flow to debt is about 1-to-1. They have about $102 billion in total debt, and they made $101 billion in free cash flow this year. Oh, the last 12 months. Now let's have a look at their efficiency. So gross margin, 43%, fantastic. Their free cash flow margin, the one I like to look at, is 26%. So pretty much what they do is they make $400 billion revenue, 100 billion turns into free cash flow. I love to see that. Anything above 15% is great. So seeing 26% is absolutely incredible. You can see return on assets, 28%, return on invested capital, 41%, return on capital employed, 54%. So a very, very efficient company. They've actually been increasing their efficiency over time. Now, fundamental score, this is something that Alpha Spread does. Whenever I look at companies, I always filter for profitability and solvency above 70. Anything above 70 is great. Now it does say here they don't have positive net debt. I don't think that's an issue. I think that positive net debt is not an issue at all. But other than that, great profitability, great solvency score, really, really good. Now let's have a look at Wall Street estimates. And this is Wall Street's revenue forecast. You can see that they're estimating 5% growth over the next 4 years, $394 billion to $485 billion. Operating income, it's another 5%. And because Apple buy back all their shares, they're looking at 7% net income growth over the next 4 years, from 100 billion to 130 billion, which again is just crazy if you think about the fact that in 2014 it was $40 billion. Tim Cook has turned this company into a behemoth. Let's have a look at the discounted cash flow analysis. So Alpha Spread do this for their DCF. They give you the worst case, the base case, and then the best case. So we're using these revenues, as you can see right here, for year 1, 2, 3, 4, 5, your terminal growth rate. We're using a 9% discount rate for the next 5 years and a terminal growth rate of 0%. And the base case you could see is Apple is fairly valued at $102, currently overvalued by 39%. On the base case, Apple is actually undervalued by 2%. And this just includes a discount rate of 8.56% and a terminal growth rate of 3.3%, which again isn't really crazy. I like to use the base case. And then at the worst case, Apple is actually overvalued by 63%. But this actually includes like negative growth. If you look up until 2026, Apple isn't going to be growing negatively, but anything can happen. It's always good to have that right there. And it does apply a higher discount rate too. But I think the base case is actually pretty fair, considering the fact that most companies will have some form of terminal growth rate anywhere from 2 to 4%. And especially with the company like Apple, when they do have such immense pricing power and such a strong brand name and a huge install base, you can actually apply a terminal growth rate of 2%. It wouldn't be unreasonable. So it's always good to look at the fundamentals of a company, but looking at the fundamentals is one thing. A lot of the market also has to do with psychology. And let's talk about investor psychology, because in the last few days, we've seen a huge sell down. The NASDAQ is down 2.3% for the past 5 days. From peak to trough, the NASDAQ was down about 4% for the entire week. So it was a pretty brutal sell-off. Selling peak to trough 4% in a week is quite aggressive. We did see some consolidation happen towards the end of the week. It's very hard to say that the bears didn't win this week. They did. The market is in extreme fear right now. A lot of people are fearful. Okay. And as investors, sometimes you need to take a step back and just look at the fundamentals and ask yourself, has anything changed? People lose money when they let their emotions govern their investment behavior, because it leads to irrational decision making that costs them dearly. It's always best to just ignore the trend at the moment. If the trend is down, look at the fundamental thesis of the company. Whether you're bullish or bearish, stick to your plan. If your plan is to buy profitable companies at a fair value and hold for the long term, stick to your plan. And if the stock market starts falling and your company gets to an even better price, a more attractive price, you need to pull the trigger. Be greedy when others are fearful. Now let's talk about the influence of greed. Most people want to get rich as quickly as possible. We all like money, and bull markets invite you to try that. Look at the internet boom of the 1990s is a perfect example. Anything with .com at the end of it, investors were just on it. Look at cryptocurrencies, look at NFTs. If you were to get the entire crypto market on an equal weight basis, many investors lost money, okay? There's only a few good cryptocurrencies that have really generated alpha for their investors, and NFTs, such a fad. Now, the influence of fear. Just as the markets can be overwhelmed with greed, it can also succumb to fear. Whether stocks suffer large losses for sustained periods, investors can collectively become fearful of other losses, so they start to sell. And this is self-fulfilling. People sell, get fearful, They sell some more, get more fearful, sell some more, and this process just keeps going and going and going and going. It's a self-fulfilling effect. It comes full circle, ensuring prices fall further. This is why you need to divorce yourself from your emotions in the market. Look at the fundamental picture. Has anything changed? If something has changed, that's when you need to go, okay, look, we need to maybe sell this. But if the fundamentals haven't changed, hold, buy some more if it gets to more attractive prices, and look at the long term. And sometimes you just have to scroll out. You have to zoom out and have a look at the fact there was 4 recessions since 1985, here, and here. And after every single recession, the market continued to move higher, making higher highs every single time. This is the S&P 500 from 1983 to 2003. And the reason why I use this year, during most of this time, the interest rate, the cash rate, was about 4.8%. That's where we are right now. So sometimes you just need to zoom out and look at the bigger picture. Never ever follow the herd. The mass exodus from stocks shows a complete disregard for long-term fundamentals. If the fundamental thesis of your stock hasn't changed, why are you selling? Why are you emotionally following the herd? It's very hard to look at your portfolio down 6%, 7%, 20%, because humans are emotional, but you need to divorce yourself from your money, from your emotional needs, and you need to look at the logic. Now, a big reason why a lot of people get emotional is because they're not comfortable with the asset allocation. Let's say you're a father of 2 kids and a husband, you have a family you need to take care of. You probably shouldn't be 100% in stocks. What you need to be is probably 60% in stocks, 20% in cash, 20% in bonds, or even less. You need to find out what your risk tolerance is, where you are in your life, and then tailor your exposure to equities, bonds, and cash accordingly. If you have 2 newborn babies and you're gonna need a lot of cash and have a lot of sleepless nights, probably get out of some equities, have your core holdings together, maybe even get into ETFs. You don't need to manage them as well, and stay in a little bit of cash, collect the yield on cash. Cash is paying 5% right now in a money market fund. Also, stick to the fundamental principles and choose an appropriate asset allocation. Stocks have always made higher highs after recession. There's not a single time in market history where the stock market, the S&P 500, has not made a new high after a recession. And just think about Warren Buffett, the greatest investor of all time. Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you shouldn't be in the stock market. The stock market, there's a lot of volatility, and if you can't swallow that volatility, just go buy a T-bill. Now we're gonna have a look at a clip from CNBC where Tom Lee is talking about the market and the current state of the market.
This has been a victory for those who've been bearish. But to me, this is also a reminder that the stock market and investor views about equities really depends on FANG. You know, FANG didn't do well this week in earnings, and it really sort of took some of the support out of stocks. Do I think the FANG thesis is changed or broken? I mean, I don't think so. To me, if someone hasn't owned FANG all year, this is a chance to get in.
But the thesis can be intact.
So Tom Lee says that, the market sell-off this week has really been because of the mega cap 7 or mega cap 8, Facebook, Amazon, Microsoft, Google, those companies, Meta. And that has led the market sell-off because they have been the market leaders and because they're so heavily weighted in the S&P 500 and the NASDAQ. We are seeing the broader market sell off because of that.
Tact, right, that these are the places you want to be. You can have that while still saying, you know what, the stocks got too stretched and their valuations got too rich, and now it's time for a pullback.
Yes. I mean, we're down 10% from the highs for the S&P, so I think a lot of bad news is baked in, but we've also done, as you point out, a lot of technical damage, and people don't like the 10-year at 5%. I mean, this is why next week is pretty critical, because we do get some pretty important data points.
I mean, momentum's a...
So, Tom Lee goes on to say that Tom Lee is very right. The yields, the 10-year Treasury issuance is having a large effect on the market as a whole. Liquidity is being taken out of the market to go cash in on a 5.5% yield. And that's why stocks on the broader market are seeing a sell-off as of late.
Dangerous thing at times, right? I mean, you can say, well, it can carry you when the times are good for these FANG names, and that was one of the criticisms the whole time. It's 7 stocks, and 493 stink, and then now it's 493 still stink, and the 7 look dicey. That's a problem.
It is. I think there is some good news. I think this week there has been some improvement in the internals of the other 493. We did a report even last night about how the small caps are starting to look a little stronger. So I think the 493 is less bad. And in terms of returning capital and compounding capital, the FANG story is strong. So you're right. I don't know if the market's comfortable with the multiple now, but in 12 months, I think they're great opportunities.
Tom Lee is correct, and we spoke about this in our videos on, I believe, Wednesday and Thursday. Even though indices were making lower lows, new stocks making higher highs, and breadth indicators were fairly positive, especially in the small caps and mid caps. We did see a strong rotation into utilities, into materials, while we saw some of the bigger names sell off. And this is a positive factor coming into the market, and we have been seeing some of these positive breadth divergences despite indices as a whole making lower lows.
About where earnings expectations have gone. That's been the big debate. Now we're out of the earnings recession. We start to get liftoff, and then we get higher and higher as you turn the calendar into next year. Do we need to rethink where we are because we're worried about the economy? Rates are high and may remain such.
Yeah, I've got a contrarian take on earnings. Number one, if you look at the stock market reaction of those that beat, they're up 0.5%. That's better than Q1 and Q2 of this year. So actually, we're getting better reactions. It's just like you said, it's more in the 493, not the FANGs. The PMIs have turned up year over year, and historically that leads to earnings growth year over year, so it's confirming that earnings should strengthen from here. And if we look at even Q3 earnings, they've actually gone up 2% since the start of reporting season. So I think the FANG's disappointed in terms of market reaction, but the rest of the market's actually been okay, and I think that is what's going to help us get through the rest of this year.
I just wonder if there's a counter.
And Tom Lee's very right. Based on economic data and based on earnings have been very, very good, and we have seen some structurally better data, especially in the labor markets. We've seen a very strong labor market. We've also seen GDP prints, which have been coming in hot, but that being said, it does show that the economy is still strong, although it is going to impact inflation down the line. Tom Lee also goes on to say that earnings have been pretty good. 71% of companies have beat. Even though FANG have disappointed from a market reaction standpoint, the other companies in the S&P 500, the other 493 companies in the S&P 500 have been produced some pretty good earnings if you look at it on a pound for pound basis.
Counterintuitive way to look at that. So PMI is good for earnings. However, the Fed doesn't necessarily want all this to be good. Right? They want demand in some respects to start to slow down, and they've been unsuccessful in getting it to do that. So as they potentially step up their efforts to make demand slow down, that potentially hits earnings, doesn't it?
So Scott Wapner, one of my favorite CNBC hosts, because he always brings the conversation on both sides. He is fairly unbiased, and you can go have a look at a lot of his clips, and he's pretty much saying, even though we're getting all this good data, that might be good for the economy, but it's not necessarily good for the Fed because this just increases inflation and it means they have to be higher for longer. Let's see Tom Lee's response to this.
You're right. I think there is a view that the Fed is running out of patience. They're like, look, when are we going to break the economy? But I think maybe the more subtle point is I think the Fed would like to see the labor market slow down, because we know underlying the two big drivers of inflation are housing and autos. They've slowed, but the job market's still strong. Next week is the jobs report. If it's a little soft, I think that takes the edge off. And of course, next week we get the FOMC meeting. And again, I think that they're going to be patient because a lot of tightening, especially 5% 10-year, is already going through this pipeline. So I think the Fed can actually be patient.
Sure, but no.
So Tom Lee's saying, housing has slowed down, autos have slowed down. The real inflation driver is the jobs market. And the Fed is really just going to wait for the data points to come out with initial jobless claims this week, as well as ADP employment data. We're going to have a look at all of that, as well as non-farm payrolls. And as that data comes in, the Fed is going to make an informed decision. And he says, if it does come in a bit softer, along with the 5% 10-year, that's helping do the Fed's job for them, especially with housing and auto having slowed down. So he says the Fed's going to be patient and await the data.
Now, I agree with you that the backup in rates has given them the flexibility to be patient and suggests that, well, the move in rates has done some of the work for us. However, if the labor market starts to show softening, then we have to worry about what's been the whole key to this thing to begin with, and that's the consumer remaining strong. Job losses pick up, spending goes down, the soft landing story starts to unravel, doesn't it?
And another great devil's advocate point from Scott, getting Tom Lee to rebuttal it, and it's a great conversation here going between the two of them. Essentially, Scott is saying the labor market, the economy is strong because of the consumer, and that's because the labor market is strong. But if the economy were to slow down, that means the consumer weakens, less jobs. Does that affect the economy? What does Tom Lee have to say?
It's a delicate balance because, you really want to see jobs at 100,000 a month. and you want to see wage expectations cool off. So it's a tricky calculus, but I think that we don't have to reflexively say, hey, if the job market slows down, we're headed for a hard landing. That might be the market's reaction, but then that ends up being an overreaction.
You're still a Bitcoin bull?
Yes.
I want to end our conversation on that because I think it's the best performing asset class of the year.
Yeah.
Certainly one of them. It's up more than 100%. So what's your view of it here? And why has it been going up the way it has been recently?
Well, there's a couple things. One is it's been real buying. So there's real money institutional buying. We can see it in the CME volumes at all-time highs. And we know Asia has been buying again, and they've been absent. So this is true people wanting to get in. It's been a good sound money story, especially as we worry about Washington.
ETF optimism, too? Is that where you're going to go also?
Yeah, the ETF, I think, is far bigger than people realize because, again, supply is going to be only $12 million a day after the halvening. ETF could be $100 million a day of demand.